I'm here this morning with Michael Morris, who is Chief Executive of Picton Property Income, and we're going to talk about the recently reported results as well as the outlook. Michael, could we start with you giving a brief overview of those results?
Yes, of course. So our results for the year to March 23 were showing quite resilient EPRA earnings, the same as last year. That's despite general inflationary cost pressures. In terms of the underlying NAV, that was lower than a year ago, recognising the wider rising interest rate environment we're in. But that was mitigated to some extent by both property level outperformance and the relatively modest gearing that we've got in the business. There was a small increase in the dividends paid, and over the year we saw dividend cover of about 112%.
Michael, you mentioned the strong property level performance in the last year. You have a very strong long-term record of property level performance. Can you just say a little bit more about that, but also the drivers?
Yes. So in the last year, we outperformed the MSCI Quarterly Index. That's now the 10th consecutive year where we've outperformed. And actually, if you look longer term, back to when we launched Picton in 2005, we've delivered upper quartile performance since that start date. 3, 5, 10 years. I think one of the reasons that we've been able to deliver consistently good long-term returns is our diversified approach, meaning that we're invested in different sectors and geographies at different points in the cycle. That's been helpful. Specifically in relation to last year, we outperformed because of the active management that was going on in the portfolio. The valuation of our portfolio declined less than the market, and the reason it declined less is because we saw better rental growth coming through, and that rental growth was driven by activity that the team were doing in re-gearing leases, granting new leases at rents at higher levels than our independent valuers had estimated.
Michael, the market environment has been very challenging over the last year. Do you have any thoughts that this may improve over the coming months?
Yeah, I think last year was particularly challenging. That there was a lot of macro noise that impacted all asset classes. Property was no exception. The final quarter of 2022 saw significant volatility. I think as we look today, we're already starting to see signs of stability in asset values after what was quite a sharp repricing. And we've also seen quite a bit of resilience in the occupational markets, and that also is encouraging. So, thinking about the key sectors in turn, in the industrial sector, rental growth continues apace, and that's really encouraging, against this continued sort of tighter supply backdrop. In terms of offices, rental growth has been weaker. There has been some. It's probably predicated in the best quality space, but nevertheless, we've seen a more encouraging sign there. And in the retail sector, where the rental growth really hasn't yet shone through, but the fact that we're seeing stability in retail rental values, I think, is a positive sign relative to previous years. And also remember that the retail sector comes off a slightly higher yield component anyway.
And in this environment, Michael, what opportunities do you see for Picton and for investors?
So I think for us, the focus is very much on growing underlying income in the portfolio in the short term, and that's captured in a number of ways. That's where we've got fixed uplifts in the portfolio. It's leasing vacant space, and it's also capturing, the embedded upside between rents that are paid to us versus the market level. The majority of our upside where rents are below market level comes from our industrial portfolio. The majority of income upside from vacancy comes from our office portfolio. And I've mentioned previously around us looking at certainly some alternative uses within our office portfolio to generate additional income upside, be that through change of use, repositioning, and potentially onward sales and reinvestment of the proceeds.
Given the opportunities that you've got within the portfolio to increase income, what are you thinking? What is the board thinking about dividend progression? You're back to pre-pandemic levels, but can you look to go higher?
Yeah, I mean, for the last 12 months, we saw a covered dividend, but let's not forget that we're in quite a tricky market economically and/or with where interest rates are. So the board generally has been quite conservative, and that's why we've run a covered dividend, meaning that there's surplus profits rather than us distributing more. So the drivers to increasing the dividend really are driven by the income growth that I alluded to earlier. Picton actually is in a very fortunate position in that the majority of our debt is fixed and fixed for a long-term time horizon. So we are in a fortunate place where we don't have perhaps some of the pressure around costs that some of our competitors do at the minute. In terms of sort of thinking more widely, we're in a position of strength with low LTV. We've got this long-term track record, that we want to build on, and remembering that sort of Picton has this internalized management model where the costs are linked to not the assets under management, but the costs are linked to the work involved in running the business. And I think that's a positive attribute as we look forwards and look to possibly growth opportunities.
Thank you very much for that helpful update, Michael. You have a trading update in July, I believe, and so we look forward to tracking your progress through the coming year.
Thank you.